It is better buying conditions now than I've seen for the last sort of 5 years, Reece, because I can get deals now under market value, under replacement cost. We're buying things now 60% under replacement cost.
Lachlan, today I want to talk about, is now a good time to buy? Deep dive with you into some actual real life case studies.
Absolutely. We've got 4 independent case studies, and these case studies are great because we'll go through 4 very different situations with 4 very different answers, Reece. Every client I'm speaking to now requires a different strategy. If you want to get ahead and make money in real estate, the right time to invest is now.
Let's talk through case study 1. It's the Sydney unit owner sitting on some equities.
I'm very confident if that person invests today, they're going to look in 3 years' time and goes, I'm glad I got into that market.
You're listening to the Follio Property Podcast. I'm Reece Beddall, and I'm here each week with my co-host Lachlan Delahunty. Lachlan, today I want to talk about, is now a good time to buy? Because there's a lot of noise in the market at the moment. It's a lot of negativity in some areas. There's a lot of micro markets that are moving. So really want to unpack those areas there, talk about the current landscape from an interest rate perspective, and then deep dive with you into some actual real life case studies.
Absolutely. We've got 4 independent case studies, and that's really the question here. Is it the right time to buy? Very dependent on your situation. And these case studies are great because we'll go through 4 very different situations with 4 very different answers, Reece. So if you are listening and you want us to talk through your case study, please put in the comment what your situation is and we'll endeavour to answer it on the next podcast.
Hey guys, quick thing to share. If you're serious about investing in Australian property right now, you need to see what we put together. It's called the National Investment Report, and it's our brand new monthly deep dive into exactly where the market is moving, what the data is saying, and what the smart investors are looking at right now. And you can get the first access completely free. Just scan the QR code on the screen right now or click in the link below to fill out the form. Let's talk about the market in general right now, because it is a 2-speed market where you've got big capital cities like Sydney and Melbourne on a macro level showing serious signs of decline. You've got the other markets that were going on a sharp increase now starting to slow down now. Is there opportunity in this market right now to invest?
There is for the right client. And again, this is important. I said to you off air, Reece, the analogy is you don't go to a doctor, your GP, and he just serves out the same medication for every problem. You come in with a cold, he gives you meds. You come in with back pain, he gives you the same meds. You come in with influenza, he gives you the same meds. The same is with property. If every client I'm speaking to now requires a different strategy or a different form of medication in terms of what that property solution or not property solution is for them. And post-budget, it's never been more complex. I've not seen my independent advice amongst the people I'm seeing differ from client to client so dramatic as it does post-budget. And that's because the landscape has changed. I spoke about on an episode a couple of weeks ago how I was frustrated that there's leading voices in our industry that are trying to dismiss what has happened over the last 6 months as just noise. There was a budget. I don't care about a budget. There was change to self-managed super fund. I don't really care about that. How can you not care about that, Reece? Like, that impacts every client very differently. And how you maximise the benefit that's still in play, whether that's re-engineering the interest in one of your investment properties to get the negative gearing on that, to then positively gear the future purchase because you don't get any negative gearing on that, whether it's a time to now upgrade because you get exempt from property place of residence, or I get a question, should I downsize now? Okay, well, it's probably not the right time because what you're downsizing, that, call it that $2 or $3 million asset that you've got, that market's pretty soft at the moment. You're going to be selling and then entering into a very competitive market. Maybe that's not the time for that. Maybe let's hold that thought for another 12 months. So every client situation is very, very different.
Have you seen, post everything that's gone on with the budget, the SMSF, the trust lending, have you seen any new asset types or areas getting a significant push, or not necessarily new, just some getting more noise around it than what they previously were, say if we were sitting in these chairs 12 months ago?
3 assets that I'm seeing and getting asked about a lot. Firstly, commercial. And commercial is going to get pushed a lot because it's more complicated, and your mum and dad investors are typically more prone to bad advice. It's extremely complicated for them. And so spruikers have now wrapped their head around some of the commercial terminology and using that to persuade clients that that's a good place. And don't get me wrong, we were buying commercial for clients before the budget. We've bought commercial for the last 6 years, and it fits for the right client in the right portfolio. I'm very pro-commercial, and we are buying it currently for our clients, Reece, and I see a huge opportunity in the commercial market. But that's not for everyone, and I'm seeing a real push on that. I'm seeing a massive lean towards house and land package that's just been reframed or wrapped up in a different form. And they'll call it a strategy. It'll be an acceleration strategy. It will be a positively geared strategy. They won't say house and land package. That's a dirty term and a dirty word. But there's been a real push and justification for that, which we've got data and evidence to show that that's not the right space. And off the plan, again this morning, Reece, I did a presentation to a group, and very sophisticated group of financial planners, and one was very much pushing, surely off the plan now has a place in a portfolio. And my response was pretty direct, because he was pushing the tax benefit. You don't invest real estate for tax benefits. You typically invest in real estate for two things: to gear it and get compounding growth over the long term. And that's how you get disproportionate returns on your cash. Off the plan apartments for the last 20 years have underperformed. So why would I want to put capital into an asset class for a tax benefit when I get no capital gain? It just doesn't make any sense. So that's to give you sort of the three, I guess, asset types that I'm seeing a lot of noise around. And a big tick for commercial, love it in the portfolio. We do it and has a right place for the right client. House and land, in the form that we speak about it on the outer fringes, still doesn't sit well with me, never will. Infill development, absolutely, we're participating in that for the right clients within our group, and certainly for those in the marketplace that have a level of sophistication that can do it on your own, fantastic. Off the plan apartments, no.
Looking at the market as a whole, we've mentioned there, we are seeing the market on a bit of a downturn with the major capitals, Melbourne and Sydney. Headline media there. Some strong data to come out as well with auction clearance rates, particularly in Sydney at some of the lowest levels since COVID. But we are seeing that there's markets within markets. If you want to refer to an episode we did a couple of weeks ago where we showed the heat maps for particular Sydney and Melbourne, where you can clearly see the upper quartile is really struggling in those areas, whereas in particular in Melbourne, some of the lower quartile is actually seeing some significant price movement over the last 3 months. Looking at as a whole, there is some softening in the market. Is that creating opportunity for you then, where we're starting to see softening, or do you think there's going to be more pain in some of those macro markets? So as a whole,
it is better buying conditions now than I've seen for the last sort of 5 years, Reece. And that's, when do I want to be buying real estate? It's when I can dictate my own price, terms, conditions, and I see value in the assets we're currently buying. We weren't getting that 3 to 6 months ago. We certainly weren't getting that 12 months ago. And we likely won't get that in 6 or 12 months' time. So the question you asked me at the very start of the podcast, is now a good time to buy? The answer depends on your situation. And that's a caveat across every individual listening right now. It's not, you go to a barber shop, of course he's going to tell you it's a good time to get a haircut. We are in the industry of buying properties. So our biases would suggest that it is a good time. Take that completely away. It's not for every particular client, and it's so subjective on your circumstances. For me, as an investor, is it a good time for me? Yes, it is, absolutely, because I can get deals now under market value, under replacement cost. We're buying things now 60% under replacement cost. I'm very confident, Reece, I'm not going to be able to get that in 6 to 12 months' time, and I certainly haven't been able to get that for the last 2 to 3 years. And if I take even a short to medium term on that, 2 to 5 year outlook, I'm very confident that I'm going to get a good return on my cash. And that's what we're here to do. We're trying to understand the data to see where we can outperform the overall market.
I think that backs up what we see with our Follio Sentiment Index, where those that have 2 or more properties are getting more confident as the months go on. And I think that the circumstances is key here, right? That's why you're seeing the confidence with those that have got multiple properties. Look, myself, I've just had a sale fall through. I've got one kid, maybe another one in the next 12 months. Wife will be off work. Now I'm actually starting to have financial pressures in the back of my head. And for me, maybe investing right now isn't the best time for me because I've got other commitments. So I think it is really about understanding people's circumstances and where that fits, because like you said there, that rate lever, which we had a podcast with Reedham Saeed the other week, who's had some bold claims about how many rate decreases are going to be over the next 12 months. Once that lever gets pulled and we start seeing rate decreases, you're going to see the market heat up across the board, not just in these micro markets that are moving.
Yeah, a lot to unpack with what you just said there, but you're a perfect example, Reece. And that's why do we create PropStack for our users, right? So they can know their numbers, so then they can see how exposed they are. So you're a perfect example. You're going to go from 2 incomes to 1. And is that a good time to go and hedge a bet on a speculative asset type? Absolutely not. Is it a time to really overexpose yourself, have a low cash buffer, and increase your LVR through the roof? Probably not. So maybe it's not the right time for you to invest. But equally, that sentiment data that you discussed, there's so many people that it might be the right time to invest, but they're obviously, and very reasonably so, nervous about the market. But these same people, so that the smart money, like you said, the 2 Property Plus investors are seeing this as a great time to invest. I sit in that category, and I'm in the position where I don't have, financial commitments that are on the horizon that are going to put me into potentially a distressed situation, so I can take on more debt, and I'm confident to do that. I see now as a great time to do it. For those that don't have a property in their portfolio, or maybe have one and have been waiting for the market to cool, there's never been a right moment. Met a client the other week that's been looking for 3 years. They've completely missed the market for 3 years. When is the right time for that client? Any time in the last 3 years would have been the right time. And they ask me, I've missed the market. No, you haven't missed the market. You've missed a market. So you missed the Perth market 3 years ago. Yeah. You probably, any time since then, if you had invested pretty well in anywhere in the country, with the exception of Sydney and pockets of Melbourne, you still would have been better off to invest then. And I'm very confident if that person invests today, they're going to look back in 3 years' time and goes, I'm glad I got into that market. But that's the demographic that won't invest against all the noise that we're seeing in the market. And that's our job, is to try to educate those people that if your position or circumstances allow, the hardest thing to do is to get into the market. Once you do, as long as, again, do your due diligence, make sure it's the right product in the right market. That's a big caveat there. But you'll be thankful only if it's right with your situation and your circumstances.
The crazy thing was I was looking back at interest rates, because everything moves so quickly. There's positive sentiment, negative sentiment. It feels like it's been a whirlwind the last 12 months, but it's probably in the last 6 or 7 where there's been some real levers being pulled from the property market perspective. But just look at the last 12 months of RBA announcements, we've had 2 rate decreases and 3 rate increases, and now there's talk there could be another decrease. So within a 12-month period,
the RBA are doing a phenomenal job at running our monetary policy in Australia, aren't they?
It's literally ridiculous, because I think, and you can actually, we don't want to go down the government route again and talk about the first home buyer, what they did with that, because we've kind of done that to death. But it really does, for those trying to get into the market, that's some drastic changes. Australia, we're in a variable loan environment, right? Like I would be shocked if anyone's doing fixed.
No, we're the only country in the world that can come off to go through a rate hiking cycle, then decreasing, then to rise them to raise them again. So there's not many other countries in the world that's done that, Reece. So we are unique in Australia. Equally, we've had a really disruptive moment with and we've had a budget that was poorly timed. Now the dust has settled a little, and I look back over the last decade. You will always find a reason or a problem not to invest. And we've spoken about this on earlier episodes. Perth was a perfect example. In 2018, you couldn't make money in the Perth market. In 2020, COVID hit. The world was going to fall apart. In 2022, the market was too hot. It's a terrible time to invest. In 2023, rate rises were happening across the country. Prices were going to fall by 20 to 30%. They went up by 20, 30% over that time. 2025 hit, came and went. There was rate decreases. The markets flew again. It was a bad time to invest because the market was too hot. And then 2026, we've seen now rates increase, now potentially will decrease. We've seen a budget that's been so problematic towards property investors across Australia. So it's a bad time to invest. So over the last 6 years, there's always a reason not to. And it comes back to the fundamentals. The right time to invest is now if your situation warrants it. And that's going to be the same advice in, the next 3 weeks, 8 weeks, 10 weeks, particularly when there's such good buying conditions. And as I've always told you, Reece, I much prefer to buy when sellers are in distress than when it's a bull market for sellers and they can essentially put their price and people will pay it or overpay. And that's when it becomes problematic, and we're certainly not in that market at the moment. So good time to take advantage of that if your situation warrants it.
There's been a hell of a lot of levers pulled over the last 10 months with the rates, with the policies, with the coming out with the first home buyer scheme. What do you think's been the biggest lever that they've pulled that has actually affected people from an investment standpoint?
Interest rates. I still think they carry more weight than any policy. Any changes to lending, be that trust, self-managed super fund, the interest rate, the cash rate, has the single biggest impact on the two biggest markets in our country, which is Sydney and Melbourne. And so if market conditions continue to decline and we see another $1 trillion of values wiped off the Australian residential market, we will see people spending, because when they've got less money in their pockets or in their equity, they will spend less. We may start to see ourselves go into a deflationary environment for the first time we've seen in a long time, Reece, which may force the RBA's hand to reduce rates. I know we had Reedham on there forecasting 8 rate cuts in the next 12 months. I certainly don't agree with that. But if you look at the long-term rate cycle, it sits at about 4.95%. So that would suggest where we're at today, about 4 rate cuts at 25 bips a pop. And I think that's foreseeable. And if that takes place, you're going to see the turn of this negativity in the market to, what could be the bull markets we've seen in previous years when interest rates come off. Sydney markets and Melbourne markets that are very correlated to the cash rate could go on a turn.
For those that were looking at something like negative gearing and that being the biggest deterror for the government's announcement to remove negative gearing, it's effective obviously next year, but it affects those that are making a decision from today. What would be a response to those that have held back on buying now because of these negative gearing changes?
My response to that is you haven't sought the right advice to get the right strategy for you. Again, if you're just investing to get a tax benefit, you shouldn't have been investing in the first place. So if you're now not investing because you don't get the capital gain or the negative gearing benefit, you shouldn't and probably wouldn't have invested anyway. But you need a strategy for you if you want to be in real estate or property for wealth creation. There will be a strategy that will likely suit your specific situation, but you need to get to the bottom of what that is. Is it going to be more cash flow focused? Is it going to be heavily capital growth? Do you have a larger portfolio where development's in the mix, or is commercial and cash flow, we're into 10 years until you retire, going to be the pinnacle? Let's buy you a commercial asset at LVR 50%, and that passive income's going to replace what you're earning in your current working capacity. So it's everything scenario based, Reece, and that's what's, I think you need to really know your numbers, and we talk about that a lot, and that's why we invented PropStack, to see where you are and where you're exposed and potentially where you're underexposed. I've had tough conversations with clients in the last 3 months. They need to be doing more. They're lazy investors. If you want to get ahead and make money in real estate, you're going to watch another cycle pass itself, because the same people in 2021 and 2 that didn't invest are likely the same demographic of people that are not going to invest now. And you'll continue to blame society and policy and interest rates, and there's always a reason not to invest. And that's what I'm trying to get to the point here. There's always going to be a reason not to do something. But there's been a lot of critics in the market now that have shed a lot of blame around circumstances outside themselves. But the reality is it was just, making a firm decision and getting into the market at the right time that suited their personal situation.
Lachlan, let's bring some of this analysis you've said here and antidotes to life. I've got some case studies here that I just want to get your quick opinion on. Okay. I'm sure there's a lot of listeners out there that are in probably similar boats to some of these case studies as well. So although it's not going to be advice, they will get some value out of your commentary on this. Okay, so let's talk through case study 1. It's the Sydney unit owner sitting on some equity. So owns a unit in Sydney, bought 5 years ago, sitting on a decent equity, watching prices soften in their own market, while Perth and Brisbane continue to run, although starting to slow down, continue to run. They're wondering, is now the time to use that equity for a second property somewhere else? Lachlan, what's your honest first reaction to that? What would you need to know before you could actually answer it?
Firstly, it's unlikely they've got equity in their Sydney unit, because unit prices in Sydney have done nothing essentially for the last decade. But if they did, they might have bucked the trend. I would need to know if they plan to upgrade in the next 3 years, because if they're living in a unit currently, if they're living in that unit, but they wish to upgrade, I think there's going to be some great opportunities within the Sydney market to do that, likely in the next 12 to 18 months. So I wouldn't be investing full stop if that was my intention, because I think prime place of residence is king, because it is a tax-free environment, and there's going to be a great opportunity within that market to upgrade. Albeit, if that's not your intention, so you don't feel like upgrading or you don't wish to upgrade the next 3 to 5 years, then I would be considering an investment in Melbourne for two reasons. A, it's the best value market in the country as we speak. And two, it's a diversification play from what you currently have in your portfolio, which is New South Wales exposure. So I think there's a good balance between diversification as well as a capital growth play in that market.
Next one is someone looking at rentvesting, right? Now, very, very popular strategy, especially amongst those people in the East Coast where prices have been unaffordable for a long period of time. Now, obviously, markets like Adelaide, Perth and Brisbane are following suit. So this particular case study is renting in Melbourne, can't afford to buy where they live. So I'd imagine they're living somewhere pretty central if they can't, because the best property prices in the capital city country right now. Looking at rentvesting into another market instead, worried they're going to miss the boat or about to overpay into a market that's already run hard. Lachlan, is this a market timing question or a goals question? What matters most here?
Goals, number one. Market strategy is very important to that. They're in Melbourne, they're rentvesting. Is that correct?
Correct.
In Melbourne, rentvesting.
Well, sorry, they're in Melbourne and they're wanting to know whether to rentvest.
Okay. And they can't afford to live where they would like to live.
Correct.
They're in a market that probably represents the best value in the country, right? I just spoke about that before. There's always compromises in real estate. So here is your compromise might be where you want to live. And your prime place of residence is one of your best vehicles for wealth creation. I've always spoke about that. So if you can compromise slightly on not the location, but it might be the asset type or where you want to live to be able to make that work as a primary place of residence, that would be my first conversation with that particular client. Sitting down to see if there's a world where that scenario could take place. If it was very clear that they've got a champagne appetite and they want to live in a ritzy part of Melbourne, and that's a non-negotiable, well then rentvesting in that market would make a lot of sense, where they still get exposure to the same fundamentals, and if they're going to be in that market long term, they're not losing the opportunity cost of being out of that market. What I mean is, what you see often is if they're not participating in their own market and one day they want to buy a house, say they want to buy something for 600 and then in 3 years' time it's worth 900 and they want to upgrade for 1.4, they've been able to trade up with that market. They've been in that market through that growth period, so it will enable them to upgrade much easier than if they had been out of that market altogether or put those funds into another market where they've hedged a bet against Melbourne and lost. And that could be a regional acquisition. It could be a move into Darwin. They might buy an investment property in Darwin at, say, 600K. It does very little. It goes up to 700, yet the market that they want to upgrade in Melbourne does 50 to 60% growth, yet Darwin only does 10. Well, they've lost that opportunity cost. Does that make sense?
Yeah, absolutely. Okay, third case study here. The investor who already owns two properties. So actually, when we're looking at a lot of our audience, this is probably appeals to a lot of our audience here when we look at the data. Okay, so this particular investor has two negatively geared properties already, both fairly leveraged, but considering a third. Borrowing capacity is getting tight for this particular client, and rates haven't necessarily finished moving. So, Lachlan, the question here is this someone who should be thinking about a third property right now? Or is the better conversation about consolidating what they've got and waiting for rates to come down?
We need to know the numbers, caveat. But if they are at their sort of limit in terms of their cash buffers, their debt to incomes, then I would be saying consolidate and sit tight. What I would be doing is having a conversation with them and their broker to see if there's an opportunity where we can potentially pull out some of that equity in one of those investors to put in an offset facility, just so I can improve my cash buffer, take a little bit of stress off. Because if your repayments are now starting to mount up and it's creating a lot of stress where you may have to sell one of these properties prematurely, that's not a good outcome. So let's see if we can take some stress out of the equation, put some money in an offset facility. At that point, if there's an event where rents rise, your income rises, or we get more value in those properties, then we could potentially look at a third asset, which is going to be a little bit more cash flow sensitive than what's currently in your portfolio. That would be, in essence, that advice, but I need to look at their overall situation to see if other assets, be that commercial or development sites, could be considered in that equation, because there is a level of sophistication, there is a level of equity, but let's just take some stress away before we do anything.
And this comes back to the earlier point we were saying, where I was kind of referencing myself, where it depends what their circumstances are, right? Like once you're starting to get to those levels, it's when you start.
It could be have a kid due in 3 months, right? It changes that entire advice, and or he could be down to one income, or he could be going on a trip to Europe if he's like. You just don't know. All those external factors, school fees, come into play. But we've got to try to give advice based on these scenarios.
Yeah, and like just from a debt level as well, this just feels like you're going to an extra level of debt as well once you get comfortable with that. So, yeah, good analysis on this. Look, we'll finalise it by the last case study, someone who's actually probably the most second popular demographic of an audience member for Follio. It's the near retiree. So the near retiree with one paid off investment property, fully paid off, thinking about leveraging the equity for a second purchase to build more passive income before retirement. Lachlan, how does time horizon change the answer compared to the case studies that we've spoken about earlier?
Changes it completely, and absolutely the advice to this particular client or listener would be very different to the previous three. We have to look at what is the time horizon, because we've got less years to play with, which means we have to be far more exposed to potential risk. So straight away I'm reluctant to suggest another purchase. Be on the conservative side to see what you've got and see if the income, if you've got a debt-free investment there, it's probably paying you somewhere between 40 and 60 grand a year. What income do you want at retirement that's going to be comfortable? And if it's $80,000, okay, what are we looking? Are we going to sell down what you have currently to reinvest in a higher cash flow asset, be that commercial? Or do we look at adding a slightly high cash flow asset at a lower LVR, like it might be a 50% LVR? Again, we'll need to look at that time horizon, but we are looking at de-risking their portfolio. Not certainly taking on more exposure, more risk is not necessarily the solution. It's working out that cash flow goal. And that cash flow goal might be 120,000, which may be unrealistic, and we need to peg back their expectations to say, well, at 80,000, I think we can achieve it. This is the level of exposure we need to get you to in terms of risk. Are you comfortable with that for that return?
Look, we went through four case studies there, all different answers, all needed more information as well. And I think that probably just shows you the power of why having someone actually sit in front of you and do not every strategy is for the right person, like you were saying.
No, that's it. That last scenario, do they have debt on their primary place of residence? Because if they do, let's get rid of that straight away. What super balance have they got? Because that's going to impact what they can do at retirement. So there is, and I hate giving that answer. I need more information, because our job is to give as much advice on this podcast to inform our listeners. So hopefully I've done a bit of that, but the caveat is your unique situation will change my advice.
Beautifully said. Okay, so we've gone through four there. Bit of a overview of the market. I think from what I've gathered from what you've said there, it is very much, if it's the right time to invest for you, then it's the right time to invest. But you got to know your numbers, understand your strategy before you jump into the market. This was fun. So I think moving forward,
put some comments. Your situation. Obviously, you don't need specifics, but tell us what you are, whether you're a rentvestor, whether you've got an asset, you're looking where you live, what you're wanting to invest. These case studies are great, and we'll do another episode of this in the next sort of couple of weeks. So put in your scenario and I'll endeavour to answer it the best I can.
You've been listening to the Follio Property Podcast.